Right, good afternoon, everybody, and welcome to another online Powwow from Paraplanners Powwow. We're very pleased to be back with another series of specialist online Powwow events with our friends at Utmost. So I'd like to welcome Steve Sayer once again. Steve, if people didn't join us last week, can you just give a bit of background to you and Utmost?
Yeah, fine. Thanks, Richard. Good afternoon, everybody. Yeah, I'm Steve Sayer. I work with Utmost Wealth. I'm a technical manager here. I've been involved in the offshore investment bond industry for, well, many years now, as you can probably tell by looking at my craggy features. Work for a company, Utmost Wealth. For those of you who aren't familiar with Utmost Wealth really came about from the old AXA Isle of Man, AXA Ireland, and latterly it has taken over companies like Aviva International, Aegon, and Generali. It's got to a stage now where it's the second largest cross-border investment bond provider in Europe and has something over 31 billion pounds under administration and growing rapidly. So yeah, that's who I am. That's who Utmost are, Richard, and back to you.
Thank you very much. Yeah, we use Utmost quite a lot in our paraplanning business, so we're very pleased to have you on board supporting the Powwow again this year. So this is part two of our three-part series of a deep dive into investment bonds. Steve, for people that didn't join us last week, can you give us a quick overview of what we covered last week?
Yeah, it's a basic introduction to the investment bond planning world. We looked basically at reasons why bonds can be used, what's the demand for them, such as tax deferral, such as the investment options. We looked at the jurisdictions that they may be provided from. We looked at the type of bonds as well, capital redemption bonds and life assurance policies. And then we delved into a case study of either or. And for those of you who weren't here or can't remember, Ivor was a chap who invested £50,000 in an investment bond back in 2016. And precisely 3 years later, when the bond had grown to 60,000, Ivor wanted to take £24,000 worth of withdrawals. And we looked at the two options that were available to him. So he could take a partial withdrawal across all segments. We looked at the 5% impact, how the rest is taxed, i.e. any excess subject to tax at his marginal rate. And then we looked at the alternative of taking segment surrenders, where, of course, the only tax payable is on the gain. And that's where we ended last week, Richard.
Okay, thank you. Still, Ivor always one of my favourite case study names, so I like that one a lot. Okay. I've put a link in the chat room already, so if you click through to that one, you'll go to a special page on the Utmost website where you can get the case studies for all three of these episodes we're doing. The solution for last week is up there already. The solution for this week will be up there very soon. And you can get next week's case study. You can also see the videos both last week and this week when it's done. And also the videos from last year when we did a series of 5 events looking at more general tax and trust issues. So that's on that link that I've put inside the chat room there. Don't forget, if you've got any questions as we go along this afternoon, pop them in the chat room, or there's a link down the bottom there saying ask a question. So stick those in there. We've got a couple that have come in via email and Twitter as well. But if you can put them inside here, that keeps me from darting all over the place in different software. And there will be access to the slides from today and a CPD certificate. I'll pop the link at the very end of the session today, so you can go onto the Utmost website and get hold of those if you want them. We will finish by 2 at the latest. We did some on-the-fly editing last week because we got a bit behind on it, but I think this one we fine-tuned it, so we should be okay. So we are going to visit Ivor. We've got another case study as well. So buckle up, because we're getting straight into some detail and some numbers on this one. So this is real intermediate bond tax planning. I'm going to bring some slides up on the screen now. Steve, could you just give a bit of an overview about what it is we're actually going to cover today while I do that?
Yeah, we're going to be looking at further withdrawals from the policies, and then we'll be starting to look at other issues such as when chargeable events are deemed to occur. We'll look at deficiency relief. We'll look at the PPB regulations, which, to be fair, probably won't be an impact for most of you, but good idea to know what the regulations are and the impact. And then finally, we'll look at loans from the policy. So without further ado, let's go on to bond withdrawals continued. And here, just before we start this slide, I think it's a good idea just to emphasize the case study of last week. This was the case, the 50,000 invested 2016. The bond was written as 100 segments. And on the 31st of May, exactly 3 years later, Ivor decided to take a £24,000 withdrawal from the policy. Now, the policy at the time was worth 60,000. It's different to the slide here, and I'll tell you the reasons and the reasons why. And we looked at the gains, taking the options of a partial surrender across all segments and full segment surrender. Of course, in reality, a client would not do one or the other. The best tax position will often be achieved by combining the two. And of course, what that can mean is a little bit of hard work in terms of calculating the number of segments that need to be surrendered, the gain on the segments and therefore the tax, and the amount of 5% withdrawals or cumulative 5% is available on the rest of the segments. But that will undoubtedly be the better way of achieving the lowest tax result. Now, if you need any details on that, please let me know and we'll provide details. So onto this case study this week. Back to Ivor. It's exactly the same as last week, apart from instead of the policy increasing in value, unfortunately, the investment conditions have been such that the policy's gone down. And Ivor's exactly the same investment, £50,000, end of the third policy year. He's wanting to take a £24,000 withdrawal, monies from the policy somehow. And of course, we then analyze what the difference is, what the tax liabilities are. And of course, if he takes a part surrender across all segments, well, the calculation is exactly the same as last week. Why? Because with part surrenders, you're calculating the chargeable event on any withdrawal in excess of the allowable 5%. So even though the policy has gone down in value, there will still be a tax charge. And if we go on to the next slide, Richard.
Just had a quick question coming already, Steve, just to clarify that when the 5% clock starts ticking, so
yeah,
is it the number of complete policy years you've done, or does it include the current policy year?
No, it includes the current policy year. So you start the policy off 1st of August this year. You've got your 5% for this year already.
Okay, thank you.
All right. Now, going back to this example with Ivor and the policy going down in value, of course, the other way of taking withdrawals was the full segment surrender. And in this case, because the policy has gone down to 48,000, then Ivor needs to surrender 50 segments to get the amount of the money he needs, 24,000. But of course, the original investment into those segments was 25,000. And going through the normal chargeable event calculation means that there is no gain. So these are the options, effectively. You've got a full segment surrender in this particular example that will give no tax liability, as opposed to, of course, the partial surrender that would give a tax liability because of the difference calculations and the tax being due on the excess and not the gain. Now, when we're looking, next slide, I think, Richard.
Just had another question, actually, which I think we might be covering in deficiency relief. But the question is basically, is there a way to offset that £1,000 loss, if you like, against other tax?
Well, there can be, but only in certain circumstances, which you quite rightly say. I mean, probably about 30 minutes later or so, we'll start looking at this. And yes, it's covered in the deficiency relief slides.
We've got to do a plot spoiler, so we'll wait until we get to that one.
Okay. So the important planning points on that is if you do trigger a gain, then of course top slicing relief may be available. More on this next week. Apart from, one important point to note at this stage is the divisor that is used for top slicing purposes will only go back to the previous partial surrender if you were taking a partial surrender. Now, if you haven't taken a previous partial surrender, don't worry, it goes right back to the start. On full encashment of segments or full encashment of the policy, the top slice divisor always goes back right to the beginning of the policy. The other things to take into account is if you are taking withdrawals by segments at surrender, so pretending to produce the lowest tax charge today, it tends to be the case that on final surrender, the final gain may be higher. But of course, you've had a tax deferral period. The policyholder's conditions change. He may no longer be a higher rate taxpayer. He may have assigned the policy maybe to a nil taxpayer that can use their allowances. He may no longer be UK resident. So there's lots of things you can do to offset that potential higher tax at a later date. And of course, the other thing which is important is if you surrender segments because of the lower tax liability, then it means you've got less segments left in the policy. And should you want to take the 5% tax deferred withdrawals, then there's less segments available for those 5% to be based upon. So just a few important points that surrounds the two methods of taking withdrawals.
On the top slice divisor, Steve, so if somebody starts a bond, let's say 10 years ago with £100,000,
Yeah.
and then adds another £100,000 after 5 years, so we're now 10 years down the road,
Yeah.
and they do a full surrender,
Yeah.
they can top slice the whole lot by 10 years, not just back to the 5 years when the other money came in.
Yeah, it's very true, Richard. They can. You always go back to the start of the policy or the previous charge event as on that slide. But it's when the policy was started that's the important point, not when the additional premium was made. And to be fair, it's a very important point because what that would suggest that if you want to maintain the maximum flexibility for planning at a later date, then start the policy off as soon as possible. Even if it's for a relatively small amount, it can be added to at a later date, and that the clock, if you like, for the purposes of top slicing relief, has started to tick.
I remember back in the day, one particular life company had a particular sales aid where they'd say whenever someone was taking out a pension, take out an offshore bond as well, just for a minimum premium, because it would come in very handy later on with all those top slicing years.
And make an investment with a tax-free cash, no doubt.
That's it. Yeah.
Yeah, absolutely.
But there could be trouble ahead for that company if you can work out from that who they were. But yeah, that was what they used to talk about.
Okay. And then the next thing we've got to consider, which is an important difference, and it can be important for some clients between the two ways of taking a withdrawal from the policy, is when the actual tax that is generated has to be paid. And the difference is that if you take the partial surrender across all segments, then the chargeable event is deemed to happen at the policy anniversary. And of course, depending on when the policy was taken out, that actually could be in the next tax year. On a full or segment surrender, then it's the actual date of encashment that is the date of the chargeable event. And so that tends to be a case that tax might be paid earlier for full or segment surrenders. And of course, then the tax falls due on the 31st of January in the following year. And going to the next slide, we have a timeline, if you like, to illustrate the differences. What we have a partial surrender on the top line taking place the 31st of March this year. Now, the thing about this policy is the policy anniversary was the 7th of April, which of course is 2019-2020 year. So that partial surrender, it triggered an excess withdrawal that triggered a gain. The tax on that gain is not actually due until the 31st of January 2021. Now, if you compare that with a full surrender of the policy or by segment surrenders, which produce that smaller initial tax charge, then the one disadvantage it has, of course, here is that the chargeable event is deemed to have happened on the 31st of March this year, which means that the tax due is a full year earlier, being due the 31st of January 2020. So there are cash flow advantages on partial surrender, but it's just there for completeness, really.
Justin's just come in with a question or clarification. Is the relevant date actually the last day of the policy year, not the anniversary?
It is.
Yep. Okay, cool. Thank you.
Okay, so now we start looking at one or two more technical events, and start looking at the situation where you have two or more chargeable events within a relatively short time of each other. And so we'll be looking at these three events. So a full surrender, part surrender followed by a full surrender in the same policy year, part surrender followed by a full surrender in a different policy year but the same tax year, and part surrender followed by a full surrender in different policy and tax years, i.e. what are the implications in terms of the charge event legislation and the total tax charge.
And to buckle up, and this is what I mean by going into a bit of detail now on this one. So
okay, and what we're going to do is going to look at a case study, and this is Sophie. She's a high rate taxpayer, and she'd invested £100,000 way back in the 1st of August 2017. So the policy year runs from, the insurance year runs from the 1st of August to the 31st of July. Now, as happens to a lot of clients, Sophie has some unforeseen expense and requires funds. And let's assume that she's contacted the insurance company directly. She's ticked the withdrawal forms, and basically she's decided to take, for whatever reason, probably the wrong reason, a part surrender of £40,000. And remember, that part surrender would be an excess. There would be a tax charge on that because you're in the second policy year. But we assume that she's seen her financial advisor and he's recommended surrendering the full policy for £70,000, and we'll look at the tax implications of those two events. So if we have the two events, the part surrender followed by the full surrender in the same policy year, well, what is the tax position? The 40,000 withdrawal is an excess because Sophie only had two lots of 5% available, so 10,000. So she's got potential higher rate tax liability on 30,000, so £12,000 potential tax liability. But Sophie surrenders the policy before the 1st of August, i.e. before the end of the policy year. What is the tax position? And simply, this is good news because the partial surrender can be completely ignored. For the purposes of the chargeable event calculation, the two are, if you like, amalgamated. And we use the tried and tested formula, the A plus B minus C plus D, substituting the full figures into the equation, and we get a £10,000 gain that has occurred. So no excesses, just 10,000 on the actual policy gain. And of course, that would be payable through self-assessment as described in the previous slide. Now, the interesting point is, well, what happens if those two events take place over different policy years? And we'll assume it's in the same tax year. So again, just to recap, part surrender in June 2019, 40,000, we know there's a 30,000 excess there. And Sophie fully surrenders her policies, this time on the 1st of September, which is now in the third policy year. What is the tax position in this particular case? And going on to that next slide, then basically, if you make a full surrender, if the insurance year falls, both starts and ends in the same tax year, it can be extended to the previous insurance year, which means that although those events took place in different insurance years, they can be again amalgamated for the purposes of the final chargeable event equation. So we can ignore the excess. The gain is calculated exactly the same as before, and we have a £10,000 gain. So for those clients who have made a mistake, who have taken an excess, if they surrender their policy and the policy year starts and finishes in the same financial year, then there is often quite a scope to right that event, if you like. And then we come to the final situation where we have the surrender happening in one policy year, and the surrender of the full policy happening in a different policy year and a different tax year. So part surrender as before, June 2009 in the second policy year, excess exactly the same as before, but this time Sophie fully surrenders a policy on the 6th of April 2020. It's worth exactly the same, still 70,000, but it is now in the third policy year, and it's also in the subsequent tax year. So now what is the tax position? Can everything still be brought together like they were before? And unfortunately, the answer is not. On a situation like that, the excess will give rise to a tax charge. The tax charge will be £12,000 on that excess, on the 30,000 gain, and on that basis, sorry, next slide, please, Richard. And then what happens when the policy is fully surrendered? Well, again, we go back to the formula. We now substitute the figures into the formula, the £70,000 surrender value. We add in the 40,000 previous withdrawals, take off the initial premium, and then take off the 30,000 excess that we've paid tax in as well. The last two figures should be in brackets there, I do apologise. And what we've come up with there is a negative figure, a £20,000 loss. Now, the good news is it's not a gain, there's no tax liability. But the question is, what can we do with the loss? What can Sophie use the loss for? And this is where we come back to deficiency relief. And deficiency relief can be useful, but it's not the full answer to all the problems of the policy. It cannot be used where the gain, where the policy has has resulted in an investment loss. It cannot be used to offset the loss of one policy against the gain from another. It can only be used where there is a negative outcome on the final chargeable event, and only then to offset against previous excesses under that same policy. That is deficiency relief. It can be available to reduce the higher rate liability of an individual. It will not reduce any basic rate liability. It will not reduce other events where there may have been an excess, such as the deemed gains on personal portfolio bonds. It can only reduce excesses that are allowable, so i.e. that have actually been taken as a withdrawal, and where tax would have been payable on the policy, even if it fell within the policyholder's allowances.
Justin's come up with a question about the recent court cases about the disproportionate rulings that have come out, and I think we might touch on this a bit later on, but I'll ask a question now. He says, do these recent tax commissioners cases mean this treatment for corresponding deficiency relief can be challenged?
As far as I'm aware, I don't think it can be. The only thing that I think you have to be careful of is that it's the policyholder himself that has actually had the tax charge on previous excesses, and in which case then you should be okay. There used to be some tax schemes around where policies were taken out, maybe by somebody who were not resident in the UK. Excesses were triggered whilst abroad, and therefore no UK tax to pay, and then the policy brought into the UK. But that has now been stopped. So I find it difficult to see how it could be.
Okay, I think Justin has just clarified he was talking about partial encashments, deficiency relief and partial encashments.
Okay. Yeah. I'll. Can I think about that one then?
Yep, okay, we can come back on that one. And one last question before we move on to the computation of this is around when we talk about it can only reduce higher rate liability. I assume it can also reduce the additional rate if you're up at the 45%. That applies as well, or is it capped at the 40?
It is capped at the 40, I'm afraid. So so although it's there, and although it's a useful relief, it doesn't provide all the answers under all circumstances, unfortunately.
Yeah. Okay. And just on Justin's question again, yeah, I mean, we're cross purposes there. We're going to talk about the disproportionate rulings a bit later on. This is different than deficiency relief.
Okay. Right. So the computation of the deficiency relief, obviously what you do is you apply the chargeable gain calculation to the final event. If the result is not negative, no deficiency relief will be available. If the result is negative, then you need to look at the amount of the loss given by the gain calculation, and you determine the total of gains on previous chargeable events, which form the part of the total income of that individual. And again, you exclude things such as deemed gains on PPBs. And then the amount of deficiency relief is the lesser of the two amounts in steps 2 and 3. And again, just to reiterate what you said earlier, Richard, and I think it's an important point, the relief is only available for higher rate taxpayers. For a higher rate taxpayer whose higher rate income is non-dividend income, it works quite simply by extending their basic rate tax band. The higher rate tax relief that will be available, of course, will depend somewhat on what their higher rate income is. So it'll either be 20 or 25%, depending on whether it's non-dividend or dividend income. And it will only be available in the band from 37,500 up to 150 after any personal allowances. So there's quite a few things that you need to take into account. One of the other things, and a very simple thing to say, of course, is that if the individual is not a higher rate taxpayer, then just by extension, there is no deficiency relief available for that policy holder. So coming back to Sophie, we know that she'd made 30,000 previous chargeable gain in the last case study. She has a £20,000 loss on the final surrender. And from the previous slide, the deficiency relief is restricted to the lower amount of the two, so £20,000. And how is it applied? Well, Sophie's basic rate tax band is extended by £20,000. And say that's fine. It's great if she's a higher rate taxpayer. She effectively gets relief at the difference between higher and basic rate on that basis. If the income sits within in her basic rate band, then no deficiency relief would be available.
Just another question on this one, which we might answer next week on time apportionment relief.
Yeah.
It's to do with the interaction. If someone had a higher rate gain in a particular year, then went overseas for a bit and then came back and then had a loss, can the deficiency relief and time apportionment relief interact?
Yeah. Yes, it can. Deficiency relief and time apportionment relief can interact. Deficiency relief and top slicing relief cannot.
Okay. All right. I said we're going to do time apportionment relief next week, but I just thought I'd put that one in there while it was fresh.
Okay, no problem. Right. So coming back onto the chargeable events and one or two supplementary things that we're going to look at. So look at how a chargeable event may affect allowances, and in particular personal allowance. We'll look at cases, rulings on excess withdrawals, which I think we referred to earlier. The PPB legislation and the effects on the individual if he has a policy that is deemed to be a personal portfolio bond. We'll look at assignments and then look at loans. So first thing, loss of personal allowances. And of course, since April 2010, the personal allowance is reduced for those with an adjusted net income in excess of £100,000. So what that means is for this tax year, with a personal allowance of 12,500, should the individual's income exceed 125, then all of the personal allowance is lost. Now, where bonds come into play is that any gain from an investment bond is added to income to establish the adjusted net income, and top slicing relief does not apply at this stage. So the example we have here, Richard, it's nothing personal, by the way, Richard, has total income for this tax year of 45,000. His income tax liability simply is £6,500 after taking off his personal allowance. But let's assume Richard decides to surrender an investment bond for whatever purpose. He'd invested 100,000 into the bond 16 years ago. It is now worth 180. So it's got 80,000 pounds gain there. Now that is, of course, added to Richard's 45,000 pound income to establish his adjusted net income for this tax year. And that takes it quite nicely to 125,000. And because it's now 125,000, it means his personal allowance is 0. So looking at Richard's tax position in respect of his earned income, then he's got no personal allowance now. He has now 37,500 that's taxed at basic rate, but he's got 7,500 that taxed at higher rate. So his total tax liability on his earned income is now 10,500, an increase of 4,000. But of course,
some marginal tax rates there.
Yeah, but of course, it doesn't stop there. You've got to look at the bond as well. What about the tax on the bond? And again, had the personal allowance not been lost, then Richard's income was sitting very nicely within the personal allowance and the basic rate band. And as a quick rule of thumb calculation on the top slicing, the 80,000 gain divided by 16 years would have given £5,000 top slice, which quite simply would have meant that it only been taxed at the basic rate liability. So only 16,000 tax would have been due on that £80,000 gain. But that's not the case here because Richard's lost his personal allowance. And so if we look at that, Richard's income, 45,000, he has no personal allowance. It's basically the gain from the policy, the 80,000 policy, will sit in the higher rate band, which of course means that tax would be due not at 16,000, but at 32,000. And so the full effect of this, the loss of the personal allowance, is his tax on his earned incomes increased by 4,000, and the tax on the bond gain has increased by 16,000. So it's, you need to plan this very careful, because to losing allowances is very nasty for the client. Yeah, coming back to those bond surrenders and interesting cases of late, all concerning the situation of clients taking excess withdrawals and being liable to quite hefty tax liabilities. And we have three main cases: the cases of Cleghorn, Shantiratnam, and the most recent one is Juice Lobler. Just to
Sorry.
Sorry, just to give a little bit of background. Cleghorn, he was a chap from Sussex who I think had a Zurich International policy. He'd invested something like 66,000 into the policy, and for whatever purpose, he decided to take withdrawals from the policy. And he then went to Florida to train to be an airline pilot or private flying license, whatever, and started taking further withdrawals from the policy. And even though the insurance company told him that he may be liable to tax, he continued to take them. Net result was he took large excesses from the policy, and of course ultimately had a tax liability to pay on those excesses. The second case there, a similar thing applied, where the policy was used as collateral. And the policyholder decided to take, I think, 30% of all the policy rights as a surrender, and again was hit with a large excess. But the really interesting one, the one of late, is the case of Juice Lobler. Now, Mr. Lobler was a Dutch national who moved to the UK to work in 2004. He'd invested something like 700,000 or so into an offshore bond, which was partly funded by the sale of his house in Holland and partly funded by a loan. He then came to the UK and he started to take withdrawals from the policy to A, repay his loan, and B, to help him purchase a property in the UK. And he contacted the insurance companies and he filled in the withdrawal application. And of course, Mr. Lobler ticked the wrong boxes. He decided to take the withdrawals as a partial surrender across all the segments. because quite simply, he didn't know anything else. He didn't know what the tax implications were. He simply thought that the bond, I think, wasn't standing at the gain at the time, and so any withdrawal would not trigger a tax liability. The unfortunate thing for Mr. Loblaw, of course, by taking excess withdrawals, the gains of the policy didn't come into account. The only issue was the size of the excess withdrawal. And in essence, the tax charge that would be levied on Mr. Loblaw because of this mistake, in inverted commas, was something in the region of 700%. Now, that was enough to cause obviously serious financial problems, and that indeed it could have caused bankruptcy to Mr. Loblaw. So when he was assessed to tax, he decided to appeal. And the case went before the first tier tribunal, and the first tier tribunal accepted and expressed sympathy for Mr. Loblaw, and expressed it in the case of equity. Quite clearly, the tax liability bore no resemblance to any gain or any withdrawal that he'd taken from the policy. But there was nothing they could do about it. Mr. Loblaw then appealed to the upper tier tribunal, and the upper tier tribunal, I think for the first time I can recall, actually ruled in his favor, saying quite clearly this was a mistake and there should be a degree of rectification for cases like this, particularly where hardship that would have resulted to Mr. Loblaw would result. And so that was the first case that I can remember where the mistake like this can be rectified. Now, since then, of course, we've had, if we go to the next slide, Richard, we've had legislation being enacted that gives the right to the revenue to allow a rectification of the policy if they believed it is disproportionate. Now, the problem with that is, of course, it's only the revenue who can allow that rectification to happen. The application must be made in writing to them. And of course, they will then assess all factors of the cases, including, as you see on that slide there, the economic gain, the amount of premiums paid, the amount of tax that would be chargeable, whether the gain results in a series of transactions. It might be part of a bigger scheme, perhaps. But the point is, it's only the revenue that can decide, and even then, there is no guarantee that they will allow a rectification of the policy. And certainly in the meantime, the investment bond providers, the life assurance companies, cannot rectify the policies. And that's where we are in terms of legislation. It is there, but we cannot rely on it to write all cases.
Is there any time bar on this? Because I came across a case a few years ago that happened back in 2001, where a combination of somebody investing in .com stocks, unwisely as it turned out, saw a massive loss on the bond, but took a partial surrender and created a massive chargeable excess.
Yeah.
So is there any time limit on how far back this could have happened for a client to apply to the revenue for it to be reviewed?
Do you know, Richard? Again, I'm going to take a leave of that question as well, and just double check before I come back with answers. I've got some thoughts in my mind going around that there is a time bar, but I couldn't say what they are. So can I come back to you on that?
Yeah, sure. Just one more question before we move on to personal portfolio bonds. Does a gross bond gain affect the pension's tapered annual allowance calculation too?
That is a very good question. I think the answer's got to be yes on that. But again, it's one. Can I come back to you on that as well?
Sure. Yeah. We'll do a follow-up blog on that. But I'm not sure it does. But we'll come back to people on that one.
Yeah. Okay. Brilliant. Right. So on to personal portfolio bonds. Now, just a bit of background on personal portfolio bonds, because I think it's important that the vast majority of people realize that it would be very unlikely. They'll be very unlikely to come across a personal portfolio bond. Certainly, as far as normal UK residents are concerned, whether policy is personal portfolio bond or not, they should be checking with the insurance company who is issuing that policy. And as far as the UK is concerned, I think I cannot see any circumstances where insurance companies would be issuing these policies. Now, where advisors may come across them, however, might be policies that are owned by individuals, maybe that have come into the UK, such as maybe European policies, where some of the investment conditions are a little bit more lenient, maybe allow personal shares in there. Maybe some policies actually allow private equity shares as well. And in those cases, of course, then the policy itself could be a personal portfolio bond. And the other thing to say about personal portfolio bonds, it really doesn't matter to a great extent what the underlying investments are. It's whether the policy conditions allow the investments into these PPB assets. So if a policy is deemed to be a personal portfolio bond, it means that the policy holder or a person connected with that policy holder has the ability to select the underlying assets, and that those assets are not listed in Section 520 of the Income Tax, Trade and Other Income Act 2005. Now, if you go to Section 520, basically you'll see a list of assets there. And in a nutshell, I suppose we would classify them in the main as being collectives. So as long as the policy gives the policyholder the right to select only those assets, it is not a personal portfolio bond. If the policy gives somebody else who's not connected with the policyholder the right to select assets that fall outside Section 520, such as individual stocks, individual shares, then that would not be a personal portfolio bond either. And we think of situations where a third-party discretionary manager is appointed by the insurance company to manage a portfolio of stocks and shares. That would not be a personal portfolio bond unless the policyholder can have influence. Now, as I say, that means in reality, very few clients will be affected. And it'll be very, very occasionally that anybody, I think, will potentially come across what might be a personal portfolio bond. But if it is, and if you do, then it's important to note what the tax treatment of those policies are, because it's not very friendly. The tax treatment is given by that formula you see on the slide there. So we have total premiums paid to the policy, total previous PPB excesses, and then multiply all that by 15% effectively. What that means is a deemed gain every year of 15%. That deemed gain is cumulative. That deemed gain happens regardless of the actual gain under the policy, and it will trigger a tax charge on the policyholder. So it is vitally important that the policy is not PPB, does not trigger the PPB rules, and it's vitally important that the policy conditions do not allow anything outside of the Section 520 investments if the policyholder has the ability to select. So we're looking at an example now on the next slide, and here we have Nick. He's UK resident. He's a high rate taxpayer who has invested 100,000 into a policy. The policy is non-PPB compliant. You know, maybe it was a European product that he's brought over to the UK with him that allows a wide range of investments. And maybe Nick has just fully invested in collectives. Because the policy allowed those investments, it would be a PPB. Nick fully encashes the policy after 5 years for £150,000. Now, because the policy is non-PPB compliant, we have to look at it on a year-by-year basis. we look at the deemed gains on year one, and you can see quite simply it's 100,000 premium times 15%, giving rise to 6,000 potential tax liability. Year two, we look at the deemed gains, which of course included the previous year's gain, times 15%. Tax liability 6,900, and so on through the years. And as you can see, the tax liability is building up substantially. And so at the end of year 5, we have a 10,400 potential tax liability.
Is that just notionally rolling up, or does he have to pay that every year?
He has to pay that every year. He has to pay that every year. It's a deemed gain. It bears no resemblance at all to the underlying actual gain of the policy. But that's what the price you pay for having a non-PPB compliant policy. Very, very restrictive. So he fully encashes the policy after 5 years, 150,000, and at which point we can assess or calculate the chargeable gain using the usual formula. And we have £150,000 being the policy proceeds. We have 100,000 being the initial investment. And we have 101,000 being the extent of those deemed gains over the 5 years. And if we substitute those figures into the formula, we get a deficiency there of 51,000. Now, what you can see from those figures is the deemed gains can be used in the final chargeable event calculation, which is good news. The bad news, however, the deficiency that is produced by those deemed gains cannot be used for the purposes of deficiency relief. So effectively, that deficiency there, 51,000, is completely worthless as far as Nick is concerned. So it's absolutely vital that a policy does not infringe the PPP regulations.
Is there any simple way of determining if you're looking at a policy, whether it does or not? Is it a case of going to the insurers for clarification, or do you have to go back to that Income Act?
Well, you need to. I mean, our first point of call is to check with the insurance company, of course. Then the second point would be to look at the underlying policy conditions and to see what allowable investments that are allowed under there, and if there's any restrictions, if the investment conditions are opened out, such as the policyholder itself does not have the ability to select. So those are the two things that we do. As I say, I think for the vast majority, nearly everybody in the UK, it shouldn't be an issue. It's perhaps more important with policies that weren't issued for the UK market. Okay, coming on to assignments. One of the big advantages of investment bonds is that they're freely assignable, either from individual to individual or individual to trust. And as long as that assignment is by way of gift, is not in the jargon terms for money or money's worth, no chargeable event occurs. And they are fairly unique in that sense, because if you look at any other types of assets, maybe a portfolio, maybe an OIC, a fund, if that fund is gifted from one individual to another, then of course that would be a disposal for capital gains tax purposes. So using assignments under a policy is a great way of planning. A great way of planning to reduce the tax liability by assigning it to another individual, perhaps that has a full array of personal allowances, maybe whose income is not as great as the policyholder. So I'm thinking of parent to child, if the child is over the age of 18, so has the ability to contract, or into a bare trust if he's under the age of 18, but watch the parental settlement rules. Maybe better in that case to wait until they are age 18 before they encash the contract. But an assignment for money or money worth is a chargeable event. And what we mean by that is a sale of the policy, a sale of the policy rights, sale of individual segments. That would give rise to a chargeable event. But there's one or two interesting little situations that would not cause that chargeable event to occur. Assignment between spouses or civil partners, no chargeable event. If it's policy is held as security for a debt, so maybe assigned to the lender, no chargeable event. And even on the discharge of that debt, again, no chargeable event. Then the other thing that's interesting is if the policy is assigned from spouse to ex-spouse, as it were, maybe in connection with a divorce. If it's made in connection with the divorce, you automatically think, well, this is for money. It's by way of settlement following the divorce proceedings. But if it's made in connection with a court order and in settlement of that divorce, there will be no chargeable event occur. So it's quite useful in those circumstances.
Just on that last point, I've got a question saying if the bond is part of a mutually agreed divorce settlement but not following a court order, is this also a gift?
I presume if it's again, the question has to come back: is it for money or money's worth? If it's made by court order, the fact that it's for money or money's worth would not give rise to a chargeable event. If it's not made by court order, then you have to ask the question: how am I doing this for money or money's worth, or is it an outright gift? If it's an outright gift, no chargeable event.
I think the financial remedy provisions are part of divorce cases. I mean, even if you do have a mutually agreed settlement going through collaboration or something, you still have to pass through the court process, or else you're not going to get your annex for pension sharing orders and those kind of things. So it has to be rubber stamped by the court. I think even if you don't need to go there and fight it out in front of a judge to get a court order.
Okay, good. All right, and then finally, just to look briefly at loans. Loans, the policy can be used in connection with a loan if it's used as security and if it's discharged, as I said from the previous slide. But those loans have to be made by third parties. If the loan is actually made by a life assurance company, again, probably very unlikely, but if it is, or indeed if it's arranged by the life company, then you could have a chargeable event. In that any interest, so you have a chargeable event in the first case. If you didn't pay interest, it would be a further loan and therefore a further chargeable event. And any repayment of that loan under those circumstances would be an additional premium as far as the chargeable event legislation is concerned. Now, the good news is loans not arranged by life companies from third parties are not a chargeable event for this purpose. So going on to the next slide, again, by way of summary, is that basically any loan that's arranged by the life company or lent by the life company, then you have to look at the chargeable event legislation. Whether that's the loan, whether it's unpaid interest, whether it's repayment of the loan, all those would give rise to either chargeable events or an additional premium. If the loans are arranged from a third party, and the policy is maybe assigned as security, then all those can be safely ignored and no chargeable event will occur. And finally, a summary. So hopefully we've seen up to now that investment bonds can be highly tax efficient if used correctly. They certainly give a lot of options as to how clients can take withdrawals in terms of generating tax liabilities, in terms of excesses, in terms of when the income is paid. Income tax is paid. They certainly give lots of options in terms of underlying investments and how those investments can be managed in a very tax efficient environment. And of course, with 5% there to be useful for supplementing, in inverted commas, the client's income. So I suppose the points to consider are listed there in terms of life assurance bonds and their planning. What's the client's tax position now? What's it likely to be? What's his age? Client's client's marital civil partnership situation. What's their civil partner earning? What they're likely to earn? When do they need surrender proceeds? How long are they going to invest? What's going to be their position when they take surrender proceeds? What's the likely chargeable gain? Are they going to be outside the UK? All these things come very much to the fore, but the beauty of the policy at the end of the day is that gross roll-up that can be generated and the planning opportunities that can result from the chargeable event legislation. And the big one that I think is really worthwhile, of course, is top slicing. And that's something we go on to next week.
Okay, just got time for a couple of questions. I've got one here from Robert. Basically, what's the point of personal portfolio bonds?
Well, yeah, I mean, in essence, there is no point. But historically, bonds certainly going up to, I think it was 1998, had a wide range of assets they could invest in, and these includes individual shares. So clients own company shares, for instance, and in which case you have all the tax advantages of any other investment in the policy. So gross roll-up, tax, non-income producing assets can be changed at any time. So you could see how they could be extremely useful, and you see how they could be used for, well, very, very aggressive forms of tax planning. And the revenue actually deemed that type of plan to be too aggressive, and that's why the PPP regulations were introduced. But certainly for the vast majority of clients, and certainly for any clients in the UK now, you do absolutely anything to avoid the policy being classified as a PPP because of those horrific tax consequences.
Yeah, they were a good idea when they came in, but the revenue triggered onto that a bit quick,
Yeah.
and put pay to that. Another question. Are offshore bond tax, well, basically what they're saying is the generous tax position for an offshore bond likely to be attacked by a future tax-hungry government?
Well, I mean, I suppose the question is the tax position of all bonds likely to be attacked by a future tax-hungry government? It probably depends on which governments you're looking at and how desperate they are to raise taxes. Suffice to say that bonds now, on a chargeable event, are taxed to income tax. And as we've seen from the various slides in this and last week's presentation, the income tax rates can be up to 45%. So I suppose the best that a bond is doing for a UK resident who's staying in the UK resident is deferring tax and ultimately giving rise to an income tax charge. Substantially higher, perhaps, than what the capital gains tax rates. Now, it doesn't have to be, and we'll see why next week. But yeah, on that basis, I think there's possibly lots of other areas that the government that want to raise tax may look at first before they look at offshore or onshore bonds.
Okay, brilliant. Right, just a reminder then that next week we're going to be looking at disregarded assets, the updated top slicing guidance,
Yes.
maximising the top slicing advantage. We'll look at time apportion relief, which we've kind of scratched the surface on today. We'll look at UK resident on DON clients. And if we've got time, we'll look at using bonds as part of a retirement income strategy. You can sign up for part 3, the advanced. If it wasn't advanced enough, it will be next week, the advanced session on the website. I'm just going to put a link now in the chat room there. If you click on that link, you can download a copy of the slides and also get a CPD certificate from our friends at Utmost. So that's it. Thanks for your questions. Thanks again to Steve for sharing his expertise and for brilliant editing of the slides this week to come in bang on time. So thanks so much for that. We'll be back again same time next week. And there is a live replay of the whole session, as always. It will be on the Powwow website, and that link to the Utmost website I put at the very start of the session today. So you can go back and watch them in your own time if you want to. Thanks for tuning in, and we will both see you again next week. Goodbye.